Today, I want to break down exactly how beginners can start Forex trading in 2026 using simple, proven, price-based strategies that actually make sense. If you're brand new to trading or you've been confused by indicators, news, or complicated strategies, this explanation will give you clarity. Forex trading is simply the exchange of one currency for another. Every single currency in the world has a value that goes up and down relative to other currencies, and traders make money by predicting those movements correctly. When you understand this concept, trading becomes much less intimidating and much more logical. For example, if you look at a currency pair like USD/CD, you're comparing the US dollar to the Canadian dollar. If you believe the US dollar is strong and the Canadian dollar is weak, you buy that pair. If you believe the US dollar is weak and the Canadian dollar is strong, you sell it. That's it. That's the foundation of Forex trading. Every trade you see on a chart is just one trader or institution betting on strength versus weakness between two currencies. When you place a trade, there are only two possible outcomes. Either the price moves in your favor and you make money, or it moves against you and you lose money. That's why risk management is so important. This is where stop losses and take profits come in. A stop loss is the price level where you accept that you're wrong and exit the trade to protect your capital. A take profit is where you lock in your gains when price reaches your target. Professional traders never enter a trade without knowing both of these levels in advance. One of the biggest mistakes beginners make is overcomplicating trading. They think they need to watch the news, analyze inflation data, interest rates, and economic calendars all day long. While those things can move markets, they are not required to become a profitable trader. The strategy explained here focuses purely on price action, meaning the movement of price on the chart itself. Price already reflects everything you need to know. Every buy and sell decision from banks, institutions, and major players is visible on the chart if you know how to read it. Two of the most powerful and widely used strategies in Forex trading are supply and demand trading and break and retest trading, also known as support and resistance trading. These strategies work because they are based on how large institutions move money in the market. When price moves aggressively in one direction, it's not retail traders causing that move, it's banks and large players. By identifying where those moves started, you can align yourself with smart money instead of fighting against it. To analyze the market properly, one of the best free tools available is TradingView. TradingView allows you to view charts, change timeframes, mark key levels, and analyze price clearly. You don't need a paid plan to get started. The free version is more than enough for beginners. Once inside TradingView, you can choose any currency pair and start analyzing how price moves over time. When looking at a chart, one of the first things you should notice is momentum. Large bullish candles pushing price upward or strong bearish candles pushing price downward tell a story. Before every aggressive move, there is usually a small pause or a base where price consolidated. That area becomes a supply or demand zone. A demand zone is an area where buyers stepped in aggressively and pushed price up. A supply zone is an area where sellers stepped in aggressively and pushed price down. The idea behind supply and demand trading is simple. If banks were willing to buy heavily at a certain price before, there is a high probability they will be interested in that price again. The same applies to selling. So instead of chasing price after it already moved, you wait patiently for price to return to those key zones. When it does, you look for an opportunity to enter a trade in the direction of the original move. Another commonly used strategy is the break and retest method. Markets do not move in straight lines, they move in waves. When price breaks through a key resistance level, that resistance often turns into support. Traders wait for price to break above a level, come back to retest it, and then continue in the same direction. This confirms market strength and gives traders a clean entry with controlled risk. Both of these strategies work across all markets and all time frames. They are used by millions of traders every single day. The key is not the strategy itself, but how consistently and patiently you apply it. Most traders fail not because their strategy is bad, but because they don't follow rules or manage risk properly. Once you understand analysis, the next step is choosing a broker and placing trades. In 2026, Traders place their trades through online brokers that connect them to the market using platforms like MetaTrader 5. MetaTrader allows you to execute trades, manage positions, set stop losses, set take profits, and monitor your account from your desktop or mobile phone. This flexibility allows traders to manage their trades anywhere in the world. Setting up a trading account involves creating either a demo account or a live account. A demo account uses fake money and is perfect for practice. A live account uses real money and should only be used once you understand risk and strategy. When placing a trade, you choose the currency pair, select your position size, and decide whether you are buying or selling. Beginners should always start with the smallest lot size possible to reduce risk. When a trade is placed, you may see a small negative amount at first. This is normal and is called the spread, which is the broker's fee. As price moves, your profit or loss updates in real time. If price reaches your take profit, the trade closes automatically in profit. If it hits your stop loss, the trade closes automatically in a controlled loss. For beginners, structure and rules are essential. A simple step-by-step system helps remove emotion from trading. The first rule is to trade with the trend. One easy way to identify trend direction is by using an exponential moving average, or EMA. When price is above the EMA, the market is in an uptrend and you only look for buy trades. When price is below the EMA, the market is in a downtrend and you only look for sell trades. The second rule is to identify a demand zone when buying or a supply zone when selling. This zone should be created by an aggressive move, not slow sideways price action. The stronger the move away from the zone, the more powerful it is. The third rule is to wait for a break of structure or removal of supply or demand. This means price must show strength by breaking a previous high in an uptrend or breaking a previous low in a downtrend. This confirms that the market is continuing in the same direction and not reversing. The fourth rule is to wait for a slow pullback. You do not want price to crash back aggressively into your zone. A slow pullback shows healthy market behavior and increases the probability of continuation. The fifth rule is to enter the trade only after price closes inside your demand or supply zone. This confirmation helps filter out bad trades and keeps you disciplined. Once entered, you place your stop loss beyond the zone to protect yourself, and your take profit at a logical resistance or support level where price has reacted before. Another powerful tool traders use is Fibonacci retracement. This tool helps measure how far price pulls back during a trend. Professional traders like to enter trades when price retraces beyond the 50% level, as this means they are buying or selling at a discount. Combining Fibonacci with supply and demand creates high-probability trade setups. Risk management is what separates traders who last from traders who blow their accounts. You should never risk money you cannot afford to lose. Each trade should risk only a small percentage of your account. This way, even if you lose multiple trades in a row, your account remains safe and you stay emotionally stable. The goal for beginners is not to get rich quickly. The goal is to survive, learn, and build consistency. Trading is a skill, just like learning a language or a profession. It takes time, screen experience, and discipline. Free tools, demo accounts, and practice are more than enough to start. The video ultimately encourages traders to take responsibility for their own results. Signals can help, but real success comes from understanding the market yourself. There are no guarantees in trading, but with proper education, patience, and risk control, Forex trading can become a powerful skill in 2026 and beyond. By focusing on price action, using simple strategies, managing risk, and staying disciplined, beginners can place their first trade with confidence and begin their trading journey the right way.